Hi, and welcome to your weekly macro roundup. We talk macro and try to make sense of markets that only make sense on days that bond prices are up. I'm your host, Steve Van Meter, and thanks for joining me today. And if you're new because you saw my Real Vision interview with the legendary Brent Johnson of Santiago Capital that aired last night, and they did not send me an email with my private link that they're supposed to, so I didn't actually know it aired. Thanks for joining us. Just so you know, the show is on Mondays, Wednesdays, and Fridays. Be sure to like and subscribe. See, I remembered this time to get these in early because I always forget. And if you haven't figured it out already, we like to have fun. I do have a lot of props. So kick back, relax. And if you have, and then plus we got the Royal Watermark, which is totally awesome. I mean, how can you go wrong with that? Now, as I mentioned, the interview with Brent on Real Vision aired today. It will hit YouTube in 2 weeks for those of you who do not have a subscription. It went really well. In fact, I got a message from Raul Powell, the CEO and co-founder of Real Vision. He loved the interview, and I don't have any details, well, because I don't have any details, but he personally invited me to be a part of some upcoming projects on Real Vision. So if you enjoyed me there, you're going to be seeing more of me. And if you didn't, you're going to be seeing more of me. So this morning I also was interviewed first thing by George Gammon. And no, many of you have been asking for this. And he said, Steve, my fans asked me to interview you. I could not say no after all the times they've asked me. So we had a great time, hour-long interview. He said Monday that it will be released. So look forward to that. We had a great time, a great chat. What else happened? Oh, yes. I forgot. I almost forgot. Didn't want to leave this out. So I got a call from Brent Johnson today, and he said, Steve, and I will quote, "If there's ever any doubt in your mind about your view, you're right." And then he said, "But I already know you know that." And I said, "Yes, I do." Now, Brent had some questions, and he called Dr. Lacey Hunt of Hoisington Investment Management, who, if you do not know who he is a long-only Treasury securities manager. And in a world of bond kings, I told you there were props, Dr. Lacey Hunt, he is a god. I mean, he is probably one of the foremost experts, if not the foremost expert on bonds alive today. And so Brent had some questions, and he called me to say, Steve, you're absolutely right about everything you've said. And I said, well, that's pretty cool. That's super cool. And I want to share with you something that Dr. Hunt said that I've not heard him say before, but it does make perfect sense, because he said that money in that QE swap that we talk about that goes into that collateral account, it's not money. He said it's not money. And I know you're just like, whoa. And he told Brent, he says, I've almost given up trying to explain this to people because people just don't believe me, but it is all correct, it is accurate, and is protected by the Federal Reserve Act. Now, let me answer how that works in a moment, because I want to fall back to my view that when the Fed buys the treasuries off the bank and does that QE swap, that those treasuries are off the market. Now, people don't really understand that, but they're removed from the marketplace. How do I know? Well, can you go to the Fed and buy one? I mean, do you think Jamie Dimon, maybe a week later, said, hey, Jerome, I was thinking about those bonds you bought, and I'd like to get some of them back. Can I buy them back? No. Does the Fed sell them willy-nilly? Can you go down to the Fed and say, I'd like to buy one, or I'd like to sell you one? No, they are removed from the market. They're gone. Now, they are kept as an accounting entry because the federal government has to pay interest on them, so they technically exist, but they're removed from the market supply. And this comes back to my tomato soup can analogy, where I said the Fed comes along every day and or 18 days a month and buys a bunch of cans and takes them off to some mysterious warehouse where they keep a ledger of them, but you can't buy them or sell them. They're not there. So how does the money, quote unquote, that the Fed uses to buy these treasury securities from the large commercial banks not be money? It's going to blow your mind. And I love it because Lacey is such a smart guy. He said, in order for something to be money, it has to meet the definition of money. Well, that's pretty brilliant. It's like, in order for those bonds that the Fed is buying To be bonds, they have to meet the definition of bonds. They're not traded on the market. They're not traded on the exchange. You can't touch them. Other than the fact that we know the Fed has them and they collect interest, they don't exist. He said, money has to have a store of value to be money. Now, is the money that is placed in those reserve accounts at the Federal Reserve member banks on behalf of the Fed, does it have a store of value? Yes, because we know it counts toward their reserves. It has to have a unit of account. Yes, well, we can add up exactly how much it is. We know that. We know how much it is and that it has value. But here's the third one. He said it has to be a medium of exchange. You cannot exchange the money held in those accounts. So it's not money. And he says, and that is how it is not money printing. It does not cycle back to the banks, and it does not meet the definition of money because it cannot be a medium of exchange. Isn't that really cool? Now, you know something now. If you've watched the videos on QE and you understand how this is not money printing, you know something that almost nobody in my industry knows, and most average Americans and consumers and people around the world, they have no idea. They think it's all money printing, but it can't be money printing because it's not money. It's not a medium of exchange. Can't touch it. Doesn't go anywhere. Pretty cool. Now, I did get some chance to go through the comments, and I do appreciate all the people that readily pointed out that I am a complete idiot because I do not understand that prices have gone up when I said that consumer prices have fallen for the last 40 years. And I greatly appreciate all of you who actually knew what I was referring to. And just so we are clear, this is what I meant. This is the year-over-year rate of change in the consumer price index, and that it has been trending down for the last 40 years. I did not mean to suggest that prices were actually falling. It's just the year-on-year rate of change, which is consistent with what the Fed and everybody else uses as a measure of inflation. So I just wanted to clarify that, and I appreciate that. Secondly, I want to also address all the people who pointed out that my thesis is busted and that I am an idiot. Let's be really clear about something. My thesis has not been busted. And if you think it has, I'm going to share with you how I can be so confident about it and know that just because interest rates go up for a week or a month or that day, that is not busted. Because my thesis is protected by the laws that govern our monetary system or the Federal Reserve Act. Now, if you're going to point out that I am an idiot and that my thesis is busted, please also cite where Congress has recently passed a bill repealing the sections of the Federal Reserve Act that protect the fact that my view is going to play out. I would greatly appreciate that. But there seems to be a running theme in the comments. I'm not sure what it is, and I hope soon to work through what it is that everyone's trying to point out about me. But we'll figure that out hopefully at some point. I do love all of you. I do love the comments, the good ones and the bad ones, and those who are just disrespectful get to go away. But there seems to be a recurring theme there, and I do have a good laugh with you. So even though I realize you're probably laughing at me, but that's quite all right. Let's get into the assets and liabilities of all commercial banks. Now, why, for those of you who are new to the show, this is what we cover every Friday in addition to whatever else that goes on, is because our monetary system expands as the debt expands, contracts as the debt contracts. And this is really important because people say, well, interest rates can only go up, 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 and up. Okay. Well, if debt is contracting, they have to go down to do what? Spur more lending growth. So it's so important for all the people that run around and say, oh, there's going to be hyperinflation, or there's going to be rampant inflation, or somehow this fiscal transfer is going to be super inflationary, that you have to look at the H.8 data every week, which I help break down so you can understand it. Because when the debt is contracting, if you raise interest rates, right? If the Fed were to jack interest rates up and home loans went to 7% and cars went to 10 and credit cards went to, well, already high, so let's say 50. Is that going to cause someone to run? I'm like, man, I can't wait to buy a car. I've been just dying to have 10% interest. That's not what the average consumer thinks. The average consumer wants what? Lower interest rates. And so does the monetary system. So when the monetary system starts to contract or shrink, See, I actually believe the monetary system is self-regulating, not probably a widely popular view because, well, the Federal Reserve seems to monkey with it, and so do market participants, by speculating on the movement of interest rates. But when all else fails, when things start to contract, the monetary system will attempt to keep asset prices up. And it will do that by driving interest rates down. And if interest rates are not allowed to fall, and eventually they will, the monetary system, asset prices will start to shrink until people get the picture and interest rates go down in an attempt to spur lending growth. Now the question is how low do they need to go? And everyone's like, oh man, when interest rates get to zero, if they ever do, it's going to be massively inflationary. There's absolutely no evidence to prove or disprove that. It will all depend on when interest rates get that low, how much lending demand is spurred. We don't know. It could be incredibly inflationary. It may not do much. You have to think about it. Do you think all these baby boomers who are sitting in retirement are like, man, hey, interest rates are low, I'm going to go buy a couple more homes and a fleet of cars and do it? No. When you're in retirement, you're paying down and off debt. You refi what you got. Maybe you need to fix the AC or replace some stuff, so you take on a little more debt, but you're paying it off. It's possible we could get to near zero rates and not really see hardly any lending growth. So this is why this is so important and why we need to go over it every month. And it's on the Federal Reserve website, posted in the afternoons after market close on Friday. So let's take a look at what's going on. And many people were panicked. Oh no, bond market. And I said, look, what did I say? What is going to happen is the banks pushed interest rates up. Why did I tell you that? Do you remember? I said they needed more inventory. In fact, let me pull up my data. I have the final data from this month now. Remember we talked about this on Wednesday. And let me pull my spreadsheet up. It's for some reason taking a while to load. And here in July, the large commercial banks were short $8.233 billion that they had to have the primary dealer sourced from the open market. In August, despite the oversized treasury auctions that everybody claimed were going to be bad and failed, it turned out they were so good that the banks were short $11.723 billion. They were short more money during a month of large oversized treasury auctions. So based on the 2 months I have tracked, which I know is a massively long statistic, we can now assume that in an average month, the primary dealers are going to have to go out and source $10 billion of bonds. Now, how do they do that? They could drive prices up and get people to sell, or they can drive all the sellers out by driving prices down, and everyone goes, no, gosh, Steve's thesis is so bad and he's wrong and I better sell. Yeah, okay. Work on that for a while. But it works. Interest rates go up, bond prices go down, people sell. And you got to think about, the stock market is massively overextended. In fact, I wrote a piece, and hopefully I will remember to post it on my website and link to it. It's a really nice piece about the psychology of what's going on between the equity and the bond investors. So check that out. But let's get back to the data and look what happened. Securities and bank credit, they went up $42 billion in 1 week. Now, when was that week that occurred? You say, well, it was a week ending August 19th, which happens to be the 21st. And so let's zoom in, and you see that during this period right in here, the banks bought $42 billion worth of bonds. Now, we do see rates have gone up a little more here, and guess what we're probably going to see? Banks buying more bonds. They need these things. You got to remember, not only do they have to feed the Fed at $80 billion a month, they still need to reserve against loan losses. So it's not, they got to keep adding. They can't, these numbers aren't going down. I know people say they're going to, they're not. Looking at mortgage-backed securities went up, and U.S. Treasury securities. So Treasury securities went up, looks like $19 billion, and most of the rest being mortgage-backed securities. So that's pretty interesting. How about loans and leases at all commercial banks? Wow, massive drop here. It looks like a little less than $30 billion. So that is an indicator that there is less lending growth. In fact, we're seeing contraction, and this is not good for the monetary system. Again, if you see contraction in a debt-based system, it tells you interest rates are too high. So any move higher in interest rates, so any move higher in yields will ultimately lead to further contraction in lending and lower interest rates. It's amazing when you understand how the bond market works. You know exactly where things are going to go. Let's dig deeper into the data. Commercial industrial loans down. Looks like what, about 20 some, a little over 20 billion. Residential real estate, which has been the hallmark of lending growth, down from 2.3 to 2.287 billion or trillion. Yikes. Commercial real estate flat. I still can't believe anybody wants to lend into commercial real estate right now. And how about the consumer? Down $1 billion with credit cards continuing to get paid off. Wow. Although it looks like they picked up some car loans and some other consumer loans in the midst of all that. Now let's flip over to the PowerPoints where we've got this broken down a little more granular. We can look at the M2 money supply. It is slow. It popped up again, but the growth rate is slowing a little bit. 3-month rate of change sitting at 285. If we look at the M2 and dig into it a little bit, wherever that went to, there we go. And you can see that savings deposits went up, and the M1, which is your currency and other checkable deposits, decreased, as well as institutional money funds, which we know because people keep cramming into equities at ridiculous valuations. They just can't get enough of that, which is going to be interesting when it ends. People will be amazed that the Fed can't prop up asset prices. The monetary base rose 4.831 trillion, bringing the 12-month rate of change to 48.3%. And if you're doing the math in your head, that means the money multiplier is rolling over and heading down. As I pointed out, it would when the Fed keeps doing enough QE. It will overpower the growth rate of the M2. And now the money multiplier is down to 3.82%. And where's my chart on that? Here we go. And what does that mean for the future of inflation? Well, here's the money multiplier and the consumer price index. Everybody's saying consumer prices are going to somewhere past infinity and beyond. And based on the money multiplier, it's rolling over, suggesting that perhaps the next print of consumer prices will be less than the current one, or maybe even flat to starting to roll over, depending on the time scale that you look at. You get some different pictures with that. But nevertheless, it's telling us that this inflationary route is soon coming to an end. Further evidence of that, since we're stuck on this, might as well finish through these charts. And as I've said before, you need more commercial banks to create inflation. And the number of commercial banks in this country continues to contract every quarter. And you can see the money multiplier tied to the number of commercial banks, and it is suggesting that the money multiplier is going to crash way down from roughly 3.81, and we see it got down to and below the number of commercial banks, which I expect there will be some bank failures coming. This is going to get down to potentially below 3, which will pretty much wipe out any thoughts of inflation. Further adding to the view that we're not going to see rampant inflation is, and this chart does not seem to be updated too often as people have pointed out, the import price index, which is really closely tied to the U.S. consumer prices. Go figure. When prices come into the U.S. or products come into the U.S., they get marked up a little bit, and that dictates what consumer prices here. You can see in an importing nation how close this relationship is, and unless we start to see import prices rise, which we're really not seeing them rise very much, you're not going to see inflation. So all the people that are inflationists are going to be wrong. Real estate loan growth down to 3.44% from a year ago. This thing has been running around 4%. It's very low. Historically, this thing should be up in the 6 to 7% range. And this is all despite record low interest rates. On a 3-month basis, it's growing at 0.23%. Usually real estate lending growth turns negative after recessions. So, this is pretty ugly that it's getting worse and worse. How about commercial industrial loan growth? Flat at minus 7.84% on a rolling 3-month. This thing is going to continue to head down. The year-over-year rate of change is just going to come rocketing down, because we can tell based on the 3-month rate of change. And loans and leases in bank credit, comprising of approximately 1/3 of all loans in the country. Growth rate is down to 6.23 from a year ago. The year-over-year trend is fine. Look at the 3-month rate of change, minus 2.72. Very consistent with recessions. Again, this is how you know that any move higher in interest rates is going to ultimately be rejected, because it's going to lead to a further contraction in lending and ultimately lower interest rates. And how about consumer loans? Credit card growth rate is, should say down. Again, I don't edit, minus 9.17% from a year ago as consumers continue to deleverage. There's no V-shaped recovery from the consumer's perspective, perhaps from the stock market, but not from the consumer. All right, let's take a look at some charts. Now, I want to point out that so many people talk about how quantitative easing causes higher interest rates. Okay. So in this chart, I have 30-year Treasury yields. The Fed started doing quantitative easing approximately in October of last year. They restarted quantitative easing. Interest rates are here. Just so we're clear, and I could be reading this wrong. It appears that back in October of last year, nearly 10 months ago, that interest rates were higher than they are now, despite well over $1 trillion of QE and an ongoing $120 billion a month. Now, I could be reading this wrong. Maybe I've got it backwards and that really things should be up here, but I just want to point out, for all the people that claim that quantitative easing is inflationary, is pretty baffling how the interest rates can be almost a full point lower, and on average have been a full point lower than the 2.4% range that they're 2.3 to 2.4%. If you look down here, we've been seeing in the 1.3 to 1.4, which tells us this move up here to 1.5% will get rejected. As I theorized, it looks like the large commercial banks did indeed sell bonds in here, as we saw, and they did it to get people to come in and sell on the backs of the fact that everyone thought those auctions were going to be terrible. They weren't, and that Powell was going to bring out the money blower 5,000, which he didn't. In fact, let's talk about Powell for a second. Did anything change? No, nothing changed. All he said was, he didn't say if, but this is what he meant. If interest rates get to 2%, rather than tightening or tapering monetary or QE as we've done in the past, we're going to let it go over 2% because tapering at 2% has never actually worked. And we're going to let it go a little hot. Now, we don't know how it's going to get there, and we don't have the tools to get it there. So we're just going to hope it gets there. And if it doesn't get there, I don't know what we're going to do. And he seemed really nervous. Why? Because the high-frequency data is already showing the economy is slowing down. And as I said, with these fiscal stimulus transfers, it was going to become very political. And lo and behold, we have not gotten a renewal of that. Well, we do have a little bit. I know a couple states are doing the President Trump's $300 a week deal. But overall, other people aren't getting it, and the $300 isn't enough. So what a surprise. The high-frequency data is starting to slow down. And you can just look around, drive around, and look at how places are not as busy all of a sudden. You can see the economy is rolling over. Fed Chair Powell said that the pandemic is very, very deflationary. He's right, at least about that. So that's how we know that interest rates are going to be rejected somewhere in here and will ultimately lead to lower interest rates, because if you can't get lending growth now, how are you going to get lending growth if interest rates have to go way up here to make some of you say QE is inflationary, because interest rates would have to go way up. Maybe we have to zoom out 2 years to find out how far up they need to go. So maybe we need to see them up here at 3.4 on the 30-year. So how are you going to get lending growth up here if you can't get it here? See, the monetary system is smart. It knows what to do, and it will ultimately lead to lower interest rates. Let's take a look at the mirror of that on TLT, and here's, of course, more people saying that Steve's an idiot and that he is wrong. Thesis is busted, and yes, more validation that Steve is an idiot and thesis is busted. I know, I read the comments. I appreciate them. But it's not necessarily true. There's no evidence. Now, what did we have, for those of you that love the football analogy? All right, the Treasury Bears, after being backed up, waited for the defense to take a break and then drove way down. And some of you pointed out on Twitter, Steve, I think this looks like a stop run where the sellers were breaking through stop losses. Yeah, sure looks like it, doesn't it? When you see major rapid moves down like this, it generally implies the stop losses are being hammered through. And it makes sense if you look at where those stops were, right at where support was. I mean, it seems very likely that if you were using stop losses, this is where you'd put them. Well, now the ball's sitting right just before, maybe around the 45-yard line. It's at the 50. In order for this to come even close to invalidating my thesis, you would need to see bond prices way down here and treasury yields somewhere up there on the other end of the spectrum. So the battle is not over. Let's take a look at the U.S. dollar, which got hammered today, back down below. And dollar bears are absolutely trying to get this down, trying to get bond prices down. They're trying to do anything they can to get people to buy stocks. Now, why is that? As you'll read about in my piece, it makes perfect sense why the stock bulls, or we can call them the Dow brothers, the Dow bros, that's kind of cool. Why do they need people to buy stocks? Well, they know prices are overvalued. In fact, anyone who's invested for any period of time knows that buying stocks at these valuations is absurd. And they're not buying it because they believe in valuations. They're buying it because of we're hoping there's someone stupider that buys stocks after I do. That is the theory of when you buy stocks at peaks. Because you have to hope there's someone else that's dumber. I mean, it's really true, because anybody who's sitting in cash, that's been sitting in cash, looks at these valuations and goes, hey, you know what, this doesn't make any sense. And then they see prices go up and they go, that doesn't make any sense. The point is, it's market psychology. The stock bulls are trying to push prices up and grind them up. Now, in a market cap weighted indices, you can do that by focusing your effort on a small 5 number, say, or 6 stocks, and you can get the whole index to rise. And they're doing that to make people regret their other investment decisions, because there's not a lot of people left to buy stocks. The short interest on the market is exceedingly low. There is cash on the sidelines, but it doesn't appear to be moving a lot. They want to make people regret. And who are they trying to make regret now? The people that are in bonds. And there's not a lot of people in bonds. There's really just not that many people in bonds. But how do you make someone regret their investment decision? You make bond prices and go down. You drive them down hard. You come in and use every excuse to treasury auctions and Powell's speech and whatever you can, that even though anyone that's invested in bonds is smart enough to realize that nothing actually changed in the last month. In fact, those treasury auctions were all really strong, telling you that foreign central banks know that the Fed's not going to be doing anything that's inflationary. In fact, they're going to probably end up doing more quantitative easing and keep interest rates lower for longer. That is why you saw these strong treasury auctions, because those foreign central bankers are in communication with the Fed. They know what's going on. But yet everyone claiming that this is it. But the market reacted completely to sentiment, and due to the psychology, they're aggressively, the stock bulls are trying to drive the people who own bonds out of them. Now, luckily, there's not a lot of people that own bonds, so it's not really a big deal. You don't see a whole lot of volume going in here. Now, why do the stock bulls need people to buy bonds? They need to get out. They need a way out. They know that these valuations are absurd, and they are grinding this thing higher, even though they know that it's not going to last. Because in order to get out, what you need is trading volume. You need people to come in. Look at this going into the 2008-9 crash. You notice the volumes were flat, low, 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 and then all of a sudden they started to scale up. But look what happened to price. Price didn't stop going up. But yet the number of shares trading hands did. And then in fact, as shares traded hands went up, now you see the stock prices went down. Why is that? Because the equity people need someone else to come in and regret their decision to do anything but buy stocks at absurd valuations and create enough volume so they can sell into it. That's what they need. Look at the volume now. It's poor. There is no one for them to sell into. So what do they need to do? They need to go after the last place of hope. Bond market. And guess what? When you've got the Federal Reserve, large commercial banks, and foreign central banks buying, well, there's only one thing you could say about that. Good luck. Because there aren't that many. I mean, most pension funds aren't sitting on bonds. They're short the bond market. Institutional money managers own a small portion of bonds, and the retail public is crammed into stocks. So all this pullback is not going to last. And like I said, you cannot get a sustained increase in interest rates when lending growth is in contraction. It doesn't work. It ultimately leads to lower interest rates. And perhaps, my friends, that is why I am the self-appointed bond king. I'm Steve Van Meter. Thanks for joining us today. Hope you had fun. Hope you learned something. And we will be back on Monday to see how hedge funds managers are positioned and what other news may come. Have a great weekend. Buy now. The content of this video provides education information only. It's not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicited to buy or selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steve Van Meter on personal capacity. Opinions expressed in this video that do not reflect the view of Alice Financial Advising or Steve Van Meter Financial.